Hey guys, welcome back to the Capital Mindset Show. We are your hosts, Austin and Fabio, here with another episode of this show here today. And today we're going to be talking about Starbucks. This is a preliminary analysis. We're going to be kind of analyzing the stock from many different fields, as well as kind of giving our thoughts regarding it. And then we're going to plug it into our discounted cash flow model and see what it returns. And so to start this off, let me share my screen here. And we are now over here. This is always sad to me, man. They don't have a PowerPoint. They don't have a lovely
They
PowerPoint
don't
here.
care about you. That's why they don't have a PowerPoint.
All right, maybe click in Starbucks newsroom. Maybe inside the Starbucks red holiday cup designs. Okay, who cares, bro? Who cares about the cup designs?
A lot of people do.
What?
A lot of people care about the cup designs. They really do. Yep. Comment down below if that's you.
All right, cool. So just kind of taking a look here. I think everybody knows what Starbucks is. Everybody knows the amount of brand equity that Starbucks has built. Everybody knows that Starbucks, every season they have the pumpkin spice lattes, and the holiday seasons they have the different lattes and different types of coffees.
Yeah.
I think, Fabio, are you a Starbucks coffee fan? Do you like their coffee?
It's good. But, there's other ones that are probably a little bit better, but it's like the good standard. Like they set the standard for the industry.
Yeah, it's like premium coffee,
Yeah,
but it's
the
like
price
sometimes with premium pricing, it's like, are you really getting the premium quality out of it? I don't know. I'm only like half and half on Starbucks. I'll have it like once in a blue moon, but it's not really like my go-to, if I'm being honest. I prefer to brew my own. That's just me though. But yeah, anyways, to take that kind of aside. Yeah, so sort of jumping into this now, what are your initial thoughts sort of coming into this preliminary analysis of Starbucks? What are your thoughts regarding this? Do you see any industry headwinds or tailwinds? And then do you see any business headwinds or tailwinds right now? And while you're doing that, I'm going to start to look for some current developments that are currently happening. I'm going to be researching the executive team as well while doing that.
Well, I mean, I think I can start by actually going over the recent price performance, and then we can discuss further from there. So let's see here. 5 years. So in the 5-year performance, I want to showcase this massive jump that Starbucks had. So I remember for the longest time, Starbucks actually didn't do anything. And it was from 2015 to around 2018. So about 3 years, right? More than 3 years of just doing nothing. The massive explosion, right, to the upside, 127%. You had a small, quick opportunity around the pandemic to actually accumulate shares. And that probably would have been the best moment to accumulate shares, obviously in hindsight. But if you go to a Starbucks right now, you actually see that there's a lot of lines. This kind of goes to show the power of the brand of Starbucks, right? The power that the company has in order to kind of attract that customer base. While it is premium coffee, people keep coming back. It's a workspace as well, so people enjoy going there and they actually get some work done. And they kind of built that environment that people like to actually sit there, talk, have their coffee, not just simply go through the drive-through. Even though their drive-through business has grown tremendously as well. I'll talk a little bit about a competitor, Dutch Bros. Dutch Bros, for example, and Pete's. I'll talk about Pete's as well, but Dutch Bros has done phenomenally well, and their business model focuses mainly on just the drive-through. But you have something like Pete's, which is kind of like a more direct Starbucks competitor. There are others. I think McDonald's bought a company, has a French name, and it's another coffee shop. And there's also Blue Bottle coffee. That's more like the premium space, but I think you can consider that Starbucks might fit that premium category of coffee. There's definitely McDonald's coffee, right? Which McDonald's coffee, some people say is really good, but then Starbucks is trying to compete for those people who maybe, I don't know, care more about the branding per se. And then that's where you have your Dutch Bros competing. So you can comment down below if you live in an area with Dutch Bros and tell us, or Pete's, and then tell us which one you prefer.
I mean, I can definitely tell you through my own experience too that a lot of people will just simply go to Starbucks just out of habit as well.
Yeah.
It's a part of
Yeah.
their morning routine before they go to work. They stop at Starbucks and they pick up a latte, they pick up a macchiato, and that's actually exceptionally crucial and important, especially approaching this from an investor's perspective, whereby we're seeing a tremendous amount of brand equity behind Starbucks.
Yeah.
So I think that this is actually like a pretty significant reason to be at least optimistic about the stock itself. But then again, this is raw, this is live. We haven't taken a look at any of the numbers yet. So we can't really, or I can't really say for certain if it's something that I would be, really
Well,
interested in.
I mean, I know I sometimes like to rip on gap estimates or gap earnings, and
Yeah.
that cash flow is sometimes more important depending on the business to look at that. But the P ratio was about 31, so I'm already kind of gonna guess the model is not gonna favor this too kindly. But
Yeah. Yeah. I mean, I've been doing a little bit of research on the management as you've been here. The Starbucks is led by Kevin Johnson. And kind of
Mhm.
digging into his background a little bit. It seems like he's doing a good job driving the business forward, trying to remain as objective as possible. But while you're kind of plugging that into the model there, I'm going to keep doing some more
Oh no, we're
research to
already
see if I
plugged
come up
in.
with anything.
What I actually wanted to talk about is the actual slowly but surely destruction of the balance sheet by Starbucks. So
Ooh, please
Starbucks,
do share your screen. I would love to see this.
um, let me actually find the part of the long-term debt because it's all in the long-term debt. So in the past, yeah, let me zoom out so everyone can see it once I share my screen. Don't worry, I know I'm not sharing my screen. All right. So in the past, we see, let me actually zoom in a little bit more. Yeah, there we go. So long-term debt line item, you want to take a look at this. So pretty much we saw under the previous CEO, he left the company with a tremendous amount of cash and not that much debt. So we'll go back up to the cash. So basically the
Mhm.
equivalent of the same amount. And over time, they've actually been increasing the leverage on the balance sheet, presumably to do whatever they want with it. I don't know, buy back shares or whatever.
Well, let's
So
let's let's can we confirm that now if they've been buying back shares?
um,
I
easy to do. We just take a look
Yeah.
down here.
Yep.
Yeah, they've been buying back
Okay.
shares.
Yep.
So uh, those buybacks maybe come from debt and a mixture of debt and actual cash flows. And we want to be careful with this going forward because if this trend continues and they continue to deteriorate the balance sheet, that could actually prove to be problematic. So you got something where there was a business that had a pristine balance sheet in the past and over time has made it worse and worse and worse. That should be kind of like noted. It's not necessarily like an X on the stock, just on that, but it's kind of like it was being prepared to be sold off, right? You want to extract as much value as you can from the company, then to sell it off. Um, so for example, if this what I would be doing, if I was an owner of Starbucks, I'd actually be liquidating it now.
Really?
Hmm. Yeah,
That is
and
interesting.
that's my hunch that the model is going to tell me. I'm just going off of my investor's hunch.
Hmm.
So I'll take a look at the key ratios, kind of talk from there. So from here, we can actually see that in the story. So deriving a story from the numbers, a lot more leverage has been put on the balance sheet relative to the past. You can see that in the long-term debt to capital, right? It's basically doubled, right? It was
This
a
is
little bit worse,
actually
but it's
this
basically
is kind
doubled.
of this is a interesting nuance here. The current CEO became CEO in 2017, and I'm kind of actually seeing a degrading in the
Yeah,
current ratio right now
well,
to
because the other
two.
CEO was the founder.
Yeah. So that would actually probably suggest here that like your theory, our preliminary theory, has
Take a look here.
definite credibility there. Yes. Oh wow.
However, a lot of things have deteriorated. I
Yeah.
think the profit, not the profit, the business as a whole is worse than it was back then. Take a look at the gross profit margins too. I mean, fairly changed, but still, I want to,
Yeah.
and look at the operating margins.
Wow.
Look at the net profit margins. Everything's kind of gotten worse. It's weird. The revenues, I assume, have gotten higher, but the margins have gotten worse. Earnings quality has actually gone down. I mean, it's still good earnings quality. It's still
Yeah,
good,
it is.
but still down. Inventory, let's see, gotten worse,
Yep.
better. Mm-hmm.
Yep. And to the
Okay.
audience member who asked us to put out a beginner video on what each of these ratios mean, we will be doing that
Oh, someone
soon
did
for
ask
you
for that?
guys. Yes, someone did, and I'm incredibly excited to do that.
Okay, we'll
So
make sure we get that out as well.
yeah.
So let's take a look at the model now.
Oh,
So
someone else also asked us for Dutch Bros too, so we should do that as well.
Dutch Bros will take a little bit longer to VIE.
Yeah.
Yep, and everyone knows about the VIEs and how we feel about them, but
Oh
you guys
yes, we are basically the VIE channel at this point. You
becoming the
know.
VIE channel, or at least our content. We're not the most popular maybe that talks about VIEs, but
Yeah.
the quantity of our content is pretty strong. So the analysts have a buy rating with a price target of 122.64. Let's
Mhm.
see what we can determine from that. So let's start with the standard 10%, and then let's assume no buybacks for now. And let's assume when we do assume, let's put what they've done in the past.
Yeah, and then let's assume a minimum threshold of a 6% growth. Why not,
By
right?
the way, I don't know if anyone's noticed this. I have this right here, max buybacks based on the cash flows. And so if you want to assume that they can buy 2.47%, look how much percentage of the cash flows it really takes up. So this assumes that they use all the cash flows to do buybacks. So you can kind of from there derive an assumption of whether or not that's feasible. So we're
Mhm.
actually being very aggressive, I would say. So actually, let's do 2%. We're still being aggressive, but and we're
Yeah.
not assuming them yet. So all the numbers you see here will not assume that. All right.
Yeah.
So what do you think is the max growth rate, considering that the average growth rate has been 6%?
Okay, so I would like to use 6 as our minimum threshold, and then for our max,
Ooh.
let's just go 12 for right now, and then we can increase from there, just as like a quick base to
Yeah,
start
you
at.
see, I kind of assumed this is terrible because I'm discounting it at 10%. That's an implied return of 159. So if we go back here, it looks like we have a repeat of what's going to happen here.
Mhm.
Just like no movement for a long time
Yeah.
until the fundamentals catch up, but no movement for a while. So we can
Yeah, I would need to do more research too into what exactly the CEO is doing, because I'm not exactly overly thrilled over the ratios that I saw, especially the current ratio, what I was seeing with the
yeah,
balance sheet, specifically between 17 and 18 when he stepped into the role of CEO.
let's nail it down, see what we're getting. 4.
5%.
Because let's say let me see what the revenue. So it seems like it actually might be slowing down. Yeah, I think it's going
Yeah.
to be slowing down. So I don't think even 6%, because I think this is aggressive what you're modeling out here. I think
Yeah.
let's do 6% over here. 5,
Oh wow.
4, and then let's do skip to 2, 1. Remember, look at the discount rate we're applying, 4%. That's that's like nothing. All right, so then 5%. So you see here the implied rate of return over 10 years is 62%. I'm curious. So let's go from here, right, to
Mhm.
2020. So that's 5 years, right? So 67% over the 5-year period. So I actually do think that it might be following that same pattern back again. I mean, this is a 10-year model, so it's 62% over 10 years. But I do think that right now what we're looking at is a Starbucks that is vastly different in terms of valuation, and there's a lot really priced in. So it just takes a little bit to cause the stock price to actually correct, or what it can do is it can plateau.
Yeah.
But as Michael Burry actually pointed out, it's actually very rare that that happens, but it can happen. And
Well,
Starbucks is a good
something
example.
something that I kind of noticed now that's really interesting. A negative book value and then a negative return on equity. And
Yeah,
that's a
but I
pretty
don't care about book
substantial.
value.
Yeah. And then what about the negative return on equity?
Return on equity, well, that's just getting it from probably either the equity is negative or the net income, the gap net income for that year is negative.
Okay. And then why does book value in this instance not matter to you here? Because a
Because
lot of people will see that negative book value and X this immediately because of that.
because it's the industry it's in, so they don't own a lot of the properties they're in, right?
Mhm.
So they rent them. They have a lot of lease obligations. They own the equipment, but that's about it. Why are you really just putting so much emphasis on the equipment's value? That
Yeah.
seems silly. It's they're not really going to get the same amount of value for that. Now, if a lot of the company owned a lot of their properties, and that would actually change my emphasis on book value, because I would want that to be the case.
Another key tidbit to note here is enterprise value is more than the market cap, which is our little smell test there that we typically like to use. So
I
I
mean,
also wanted to point that out as well.
it's not crazy.
It's not crazy, no, but it is more,
Yeah, it
So
is
it's a
more.
little smell. It's a little bit smelly. It's a little smelly, you
Well, I
know.
mean, it's not. Look, the balance sheet isn't terrible compared to a lot of companies.
It's not
It
stinky, a little
Yeah.
smelly.
It just has more debt than it has cash, and
Yeah.
that enables it to be at a higher EV to market cap. So,
Kind of curious about something else too.
yeah.
Give me a quick second here. I'm on their 10K right now.
But yeah, so far, I just want to summarize what I'm seeing. I'm not impressed. I think Starbucks is tremendously overvalued. For example, if I wanted to get a 15% rate of return, you can kind of see where I'd have to assume the growth rates. I'd have to assume either higher growth rates, or I'd have to get at a really low price. And yes, you're not hallucinating. Those are the prices. Now, real quick, I want to take a look quickly at the cash flows to see if there's nothing anomalous about them. And no, there doesn't really seem to be anything crazy about them. In fact, they seem to be in line and at the highest they've ever been. So I'm not actually discounting
Hold
something.
on. Go back. That's a pretty irregular story in cash flows from operating activities that I'm seeing there. Look at this.
Yeah,
It's jumping from 11 billion in 2017 all the way down to 1 billion in 2019.
Mhm.
So what happened over this time period?
Well, we can already
These are
see here.
these are the questions that like I just like to ask myself, because this also kind of suggests too why our model just absolutely hates this right now.
Yes. Well, it's only going to, we only care about the current, and then we're extrapolating from the current. But
Yeah.
for this year, we had a decently high net income. And then on top of that, furthermore, we had, let's see here, down the line items, we had this addition right here, this addition right here.
That's it. It's probably changes in inventory.
Yeah.
That's probably what I'm looking at right there.
And depreciation,
Changes.
amortization.
Yep. Changes in other operating activities.
This is the total number.
Yeah.
This could
Okay.
actually be porting in incorrectly.
1.
Yeah, I think this is porting in incorrectly. So we caught this. This is just a mistake of the API.
Yeah.
Um,
Yeah, likely is because that like I noticed that.
This one,
like, what?
This one passes the eye test, but yeah, this one passes the eye test.
Yeah, I mean like that's pretty regular to 2016 and 18.
Yeah,
and
this one seems
but,
like an anomaly, or it's not including something that's in here, like a one cash payment that they may have sold,
Yeah.
like for example, a ton of real estate.
Yeah.
Loss or gain of sale from asset. Well, they'd be included in there, but anyway. From there, we're going to extrapolate the value, and from that, it's really overvalued. So it kind of passed the smell test that the cash flows aren't extremely low. That's what I was looking
Yeah.
for. They're not. They're actually fairly high relative to the historical. And that being said, I would have to wait for either a dramatic pullback or some crazy growth. And let's actually simulate what kind of growth do we have to assume. Jeez, man, this is going to be insane growth in cash flows we have to assume. 30. What about 25? 25. What about 22? Oh, we're getting there. 23. We're getting there. 24. Boom, right there.
Nice.
We assume 24% and above, and then we can assume. Oh, we didn't assume the buybacks. Yeah, let's take in those buybacks. So now we can assume probably 22.
20. Try 20.
20.
Nope. Yes.
Basically,
about 21.
Basically.
Yeah.
I would count that. Yeah.
Okay.
20 and 21 between those two numbers. So 20 and above, or 20 between 20 and 21 and above. That's where we'd have to assume in order to get that 15% rate of return if we are assuming buybacks of 2%. And that would imply a 304% gain in the stock price. Will they achieve 20% growth rate in cash flows, while their growth rate has only averaged around 6% over the past years, more likely they're overvalued.
If I'm being honest here, a preliminary thought, I might buy puts on this,
You might
depending
buy
on
puts.
how
However,
expensive the premiums are.
yeah, take a look at the premiums, and then we can
Yeah.
actually do a video on puts and what is a nice premium, like what constitutes a good premium relative to what you're implying. And then we
Yeah.
can actually even create like yeah, we can create some content around that. Another thing I'd pay attention to is be careful, because Starbucks may plateau. And then if, for example, you're not very careful by what your put is and how much you're buying into the future, that could be bad, because if it plateaus, you might expire worthless. So you got to be careful.
Yeah.
This is a company that has plateaued in the past. I'm not extrapolating from the past and saying that will happen in the future, but I'm saying that just be aware of that can still happen.
Yeah.
So I think that kind of covers my thoughts. What are your thoughts?
Not interested in investing in the stock personally. A lot of the things, I mean, like the company has a fantastic brand equity. I think they kind of need to clean up their sheet a little bit. And their sheet isn't terrible, but they do need to clean up a little bit. They need to kind of clean up some other things. They need to clean up their cash flows. And then also, I'm going to probably explore more the option of buying puts on them potentially, because what I saw
Fair,
suggested that they were exceptionally overvalued. Now,
fair.
I don't, I can't sit here and like start to make like proclamations about certain things because this is a preliminary analysis. So I will have to do some more research before I pull the trigger on puts. But if I end up pulling the trigger on it, I'll definitely make a video about that and my thoughts as to why I
Very
decided
true.
to do that. But what about you?
No, yeah, I'm along the same lines. With the puts, I can kind of help you out, and we can kind of explore that together. Maybe I find that it is interesting, but um, we'll see. All
Yeah.
right, guys. I
All right.
think we're
Well, this is our episode of the Capital Mindset Show. We are your hosts with the most, Austin and Fabio. If you've liked what you've seen here today, please be sure to share the video. It really, really helps out the channel. Please be sure to like, comment, and subscribe, and visit our website at capitalmindset.org. And we are your hosts, and take care, everyone.